Good afternoon and welcome to this week's edition of Halftime Talk. A moment each week where we get the opportunity to take a slightly deeper dive into some of the trends and issues impacting the energy markets. And this is a unique opportunity to get Dave Ernsberger, the president of S&P Global Energy, a few days after the world's biggest thought leadership energy event that he hosts in Houston every year wraps up, to get his top takeaways. So Dave, thank you so much for joining us.
Hey, thank you, Sean. It's great to be with you here and appreciate the opportunity to catch up.
So, right into it, Dave. Obviously, while it's still fresh in mind, thank you for making the time. Sorry to have missed CERAWeek this year with all that's going on here in Dubai and the Middle East. It was a little bit awkward to get away. But lived vicariously through all the videos and postings and everything. But what are your top takeaways now you've had a few days to reflect on what is essentially probably the biggest and most important gathering of energy minds each year?
Yeah, well, Sean, before I share with you my top takeaways, just to say we missed you at CERAWeek and everybody from the Middle East who couldn't make it out. We were fortunate that some people joined by video. Some people actually did manage to make the trip for various reasons, but we missed all of our Middle Eastern delegates this year. And so just from me to you and all of them, we hope to see you there next year, inshallah, and things settle down so people can come.
Absolutely.
Now, as you say, we shared video feeds, we shared highlights of what came out of the conference. So I'll share with you my four biggest thematic takeaways. And they break down into oil, natural gas, power, and skill sets. Those are the four headlines for me. And I'll just go one level deeper on those. In the oil market, that's where the conversation among delegates at CERAWeek, by the way, more than 10,000 delegates this year, when they were talking about oil, it was all about the Middle East conflict, what was happening with Strait of Hormuz. And the big issue there is that the oil markets were broken in two ways by the conflict. Firstly, Atlantic basin pricing and Middle Eastern Pacific basin pricing completely dislocated when the war began. That's beginning to converge now. We could talk about that today. The second big break was between futures prices and physical prices. So futures prices and spot prices. That was the second big dislocation. So the oil discussion there was all about how do we think about the conflict? When will it end? What do these dislocations mean? And ultimately, how will the market come back together again? That was the big oil thematic. Natural gas, very different. The natural gas theme at CERAWeek was, wow, there's more demand than ever before for U.S. natural gas. Local domestic U.S. producers and LNG exporters believe that they can do more, Sean. They can bring more volume to market. And that is
from the U.S. side, from
the U.S. side. And that's a big turnaround from where they were maybe 3 or 4 months ago, where they felt like maybe the market was saturated and there wasn't a demand for anymore. So the gas conversation was more about how does the U.S. do more in this market. In power, the conversation is about how does the U.S. put enough power infrastructure in place to make sure that local bills don't go through the roof because of data centers and AI. It's a recurring theme, but that theme was still there. And then that fourth takeaway for me about skills is really interesting to me. At CERAWeek this year, for the first time in a long time, people were talking about shortages of people to do the work. Whether it's oil facilities, gas exports, power transmission and distribution, or any other part of the energy sector, there are not the people with the skill sets to build this economy going forward. So there was a huge conversation going on around we need fewer people with college educations and more people with skills and trades educations coming into the workforce. And it's a relatively...
I took that note you mentioned in some of your reporting. Is that a gap that can be bridged in any short-term sense? Are employers willing to employ? Are there technical colleges? I know in my countries and home countries, the technical colleges were all closed.
Yeah, yeah, exactly. So I was asking some of the logistical operators that very same question. Like, do we need to wait a generation for a whole new group to get trained up and or will they do it themselves? I talked to like Venture Global, the big LNG exporter, about this, and the governor of Louisiana. People are willing to give on-the-job training to people who are willing to look beyond their college degrees and learn a skill. Now, I don't know about you, but for me, I went through the college education system, being offered training on skills. It's a jarring discussion to have, but maybe that's where the future is for this generation.
I was having that. I was having that recently. I have three kids. The now the youngest, the other two gone to college, and inevitably this was in the ether when they were going to college. Why do we go to college? It's still relevant, and you pay
Yeah,
this kind of money and so forth. And I never even remotely considered it as an alternative for the older kids. But now the 16-year-old, the beginning of the A-level cycle, and like actually.
yeah,
I'm receptive to the discussion.
yeah,
Skills versus academia,
yeah.
400, 300 grand, whatever one spends on that university education. Um,
That's
I
right.
think it's in the debate now where it wasn't even just 2 or 3 years ago, where you
Well,
could take
Sean.
an academic, a university sort of educated family and actually say, well, actually, I'm thinking about that.
Well, 30 years ago, when I started doing this job in this business, that wasn't so unusual. A lot of people across the energy space, including in journalism, actually came from a technical skills background. So, in a way, it's back to the future on that topic, but a very urgent one as well.
I noticed one of your comments that you made during Sierra Week, which really struck me, and I'd like to sort of drill into it a little bit. The pace of innovation is light years ahead of infrastructure.
That's right.
Sort of dig into that. Give us a little bit further of your thinking there. What was said, what you took away from that.
Yeah, so I appreciate the chance to go one level deeper on that one too, Sean. So thank you for asking the question. When you sit down with folks at Sierra Week, especially, but really in any event, I would say in the West, the US, UK, Western Europe, and so on, innovation is all around us. People are talking in very vibrant, very real ways about building out data centers to power AI, to provide agentic solutions, to get ready for quantum computing. There's a lot of innovation going around in those spaces, and we hear that, right? We all hear that as we go around. But the frustration and the reason why that's so far ahead of investment, what I call money and infrastructure, is that Western economies are not really primed or prepared to step up and deliver the logistics that are needed to scale that out. So huge amounts of time were being spent by senior leaders in Houston talking about the vagaries of the permitting process. How do you get a local permit and then a state permit and then a federal permit to build a transmission and distribution network around a new facility in any state in America, actually? And then how do you avoid litigation, class action lawsuits, or not avoid them, but how do you manage them so they don't? In the end of the day, logistics in most of the Western world are designed to work at a snail's pace to meet due process requirements. And I think we can all embrace the fact that due process needs to be followed. But due process, the wheels of due process turn so slowly that innovation can be completely, in the end, missed and
Even in
outside the
Trump's
timeline.
America, where the administration would boast about, and I think the industry would acknowledge the removal of burdensome regulations.
Yeah, it's a fascinating point. This year's Siri Week was year two of the second iteration of the Trump administration. So year one last year was all about, hey, we're going to clear the way for, much more efficient permitting, much more efficient processes. That was year one. Now that we're into year two, the conversation has become a little bit more nuanced and a little bit more informed by experience, where what we've learned in the last year is that with the highest level administration support to simplify all of this, it turns out it's still really hard to do. And that's because you've got to have federal permitting made efficient, state level permitting made efficient, and then parish and city level permitting made efficient. There are layers and layers and layers to this onion. And as you pull them back and simplify them, you see how complicated it really is.
Just drill into a bit about infrastructure and data centers. I mean, the idea that innovation light years ahead of infrastructure, I think of that infrastructure, the critical infrastructure being the latest edition of it, being data centers, AI data centers, and their nexus with energy supply. How was that sort of dealt with during CERAWeek? How is it the outlook, your own outlook for that now with this dislocation in the energy, access to cheap energy?
Yeah. One of the hidden jewels of the S&P Global Energy space, Sean, is a group called 451 Research, who for 20 years have been studying 13,000 data centers around the world, which was a thankless task until now, Sean, you know? So our 451 team who look at these 13,000 data center projects, among the different conclusions they've come to is the view that in the US, power demand for data centers is currently around 50 gigawatts or so. 50 nuclear power stations. That's my interpretation more than theirs, okay? But 50 gigawatts, 51 gigawatt nuclear power stations. By 2030, so really in just 4 years from now, to meet the need to supply existing and new data centers, that number needs to go to 110 gigawatts. So 110 1 gigawatt nuclear power stations. Of course, a lot of that is going to be gas fired, maybe even coal fired. That was the conversation at CERAWeek. Hey, what's the space for coal in here? But no matter what your feedstock of choice is, doubling the size of the power sector that feeds power centers and data centers, that's really hard to do, and that's where innovation is ahead of capacity right now. If you could use all the feedstocks available to you, you still couldn't build all those power centers behind the meter, in front of the meter, on top of the meter, under the meter. It just can't be done. I was involved in conversations where people were talking about building data centers in space. Have you heard that one?
I've heard it, on the moon, actually.
Yeah, correct.
Somewhere that I can't remember where I came across it, but
Yeah. There were some people who thought that was more likely to happen than to happen in West Texas, just because of capacity constraints. It's
now I
easy.
know why they're going to the moon this weekend.
Well, you know what? It all makes sense when you think about it that way.
Well, it certainly, I've got an interesting company we're working with at the moment called Deep, and they're building underwater ecosystems and environments. And one of their driving sort of commercial opportunity or aspiration is to create a suitable underwater environment for
Right.
data farms, given all of the cooling challenges. Dave, I wanted to talk a little bit about, I mean, going into the oil and gas space. Going into CERAWeek, or certainly over the last year or recent years, some of the challenges to the pricing structures in the world was the flows, the redirection of flows after Russia's invasion of Ukraine, products and crude moving east that was previously moving west, and all of that redirection of flows. I mean, the US now 10 years since or so since Obama allowed exports of crude. It's hard to imagine that it's only 10 plus years that the US exported crude oil. But just how flows in recent years impacted pricing, and now with this disruption in the Gulf here, what sort of impact has that had on flows and the intersection with pricing?
Yeah, thank you, Sean. It's probably the most urgent topic in the world today, actually. When we look at the oil sector, how can flows adapt to the fact that the Strait of Hormuz has now been effectively closed for oil shipping for a month, and it could persist for much longer? And no matter what, when the strait begins to flow again, we have now seen how easy it is to close the Strait of Hormuz. And there are now questions about Red Sea and what's going on with the Red Sea flows out of Jubail and elsewhere. So the theoretical vulnerabilities of energy flow have been demonstrated to be real, actual vulnerabilities, and we've now seen the impact of that. So I guess I'll give you a good news, bad news read on all of this, right? The good news here is that the energy sector has been preparing, genuinely preparing for disruptions like this for 30 years. It's not as if people were sitting around wondering what might happen and then hoping it didn't happen. From a logistics perspective, Abu Dhabi's pipeline to Fujairah now fully in use, right? The Saudi Arabia East-West pipeline, allowing them to move crude out to Jubail in the Red Sea, I think fully in use. If they're not both being fully used, they're not
Beyond
both
fully, they're over
over
driving the
capacity,
engine
right?
there.
So when those, I don't know if you remember, but when I remember when those pipelines were built, a lot of people were kind of scratching their head and wondering if it made any sense because the natural flow was through the strait. They were both built with this kind of eventuality in mind, at least partly with this eventuality in mind, and also to expand capacity, of course, right? So the wisdom behind those investments have proven to be true. From a benchmarks perspective, we've been planning around Platts Dubai for how we would assess that market in the event of the Strait closing down, and that's been working as well. We have crude being delivered against Dubai out of Fujairah and out of Mina Al Fahal in Oman, and so that's working. Still, two-thirds of deliverable crude against Platts Dubai is still deliverable against Platts Dubai. But there's a much bigger question around flow because I mentioned at the start of our call today, the east-west breakdown in the physical flow market meant that WTI and Brent were often sub $100 this month in the month of March 2026, when Dubai was well north of 130, 140. That arbitrage has to be closed. We're now seeing that heading into April. I was looking at Dated Brent last night, $123 for Dated Brent in the North Sea. That's up, 30, 40% from where it was a week or two ago because the flows are starting to move to close those gaps out, and it's pulling Atlantic crude prices higher to meet the needs in the West. And I guess what I'm trying to say here is taking out 20% of world oil supplies massively hits the Eastern markets, Asia Pacific and the Middle East. Everywhere from India to China and everything in between gets affected by that. Flows will need to be rewritten massively to meet the market need in Asia Pacific. And we're
On,
seeing
let me just jump in on that point, David. Do you have any regrets about the Dubai assessment mechanism being left in force? Has that been
um
a bit unfair to the Asian refiners and hence the consumer?
we're very fortunate, Sean, that in Platts we have the world's most connected network of suppliers, consumers, refiners, NOCs, traders, and brokers to talk to about that. The world needs to know what the value of a spot market is in normal times. The world desperately needs to know what the spot market is during times of distress. And so I'm very proud that we continue to produce a Platts Dubai assessment, a Platts Oman assessment, a Platts Murban assessment to help the market understand what the physical price is and was during this conflict so that those rebalancings can be done, so that arbitrage can be performed. Look, I'm like anybody else understand the the grave importance of price inflation and price sensitivity to every economy in the world to energy. That's one reason we exist is to help people understand how markets can work most efficiently. Producing prices that represent market value, even if it's bad news for some people, is an essential function in the marketplace. I'm very proud that we can keep producing that assessment based on the methodology we put in place to survive the Strait being closed. And then our job now is to explain why those numbers are where they are and help people understand where the market might go from here.
Is it true that various parties consulted S&P Global immediately after commencement of hostilities to check whether S&P Global would maintain the goalposts or change them, or how did that dialogue occur?
Well, we'll always maintain the assessments, and we're very public about the methodology, Sean. And absolutely, people reached out to us the minute the conflict began over the weekend, right, to understand. We reached out to people in the market
It
as well.
started on a Saturday, of
It
course.
started on a Saturday, right? So we are always on all the time, and we were in consultation with the market right away. Now, we people ask us why have we made the decision that crude oil delivered behind the strait, inside the Gulf? Why that's Upper Zakum, Al Shaheen, some of the Murban coming out of Jebel Dana. Why wouldn't that be deliverable against Platts Dubai? And the reason for that, Sean, and this came out of many, many, many consultations, is that crude loading behind the strait is a distressed barrel in the spot market today. I'm not saying it's a distressed barrel in the term market. The term markets continue to function. We're watching that very carefully. But in the spot market, if somebody offers you a cargo of crude oil behind the strait, you don't know if you can get a ship in there to pick it up. You don't know what you can do with it when you do pick it up. It's a distressed market with a different value, and benchmarks have to represent tradable, fungible barrels that can move around the world. And that's what Dubai does today.
Let me ask about the sort of disciplinary sanctions. Are S&P Global able to impose equivalent disciplinary sanction on protagonists in the Middle East benchmark as they've done it over the years with protagonists of the North Sea benchmark?
I don't know if I understand your question.
That there has any, I mean, there's been some speculation that Dubai market protagonists have kind of boxed in the Dubai contract, and the idea that one might, you have in the past set people out of the window for
I see.
mismanaging the process, if you like, without
Yeah,
sort of
no,
over punctuating the point.
no, that's right. I wasn't sure when you mentioned sanctions and so on. It got me a little nervous. Obviously, we're not a government authority. We're not a regulator.
Of course, yeah, yeah.
We don't,
But you manage the window and
well, we
occasionally
manage our assessment process. That's right.
process. Yeah.
So look, when companies uh, are unwilling to follow our methodology, we don't include their data in our benchmarks, right? That can mean everything from we won't publish bids and offers from those companies, intentions to trade. That does happen from time to time. Now, also, if a market is if a participant isn't considered to be credible in the market, we might not publish their information for that reason either, quite frankly. But no, the MOC, the market on close assessment process for Middle Eastern crude, has been very active and very dynamic through the whole month of March. We've had double-digit numbers of companies on both the buy side and the sell side of Middle Eastern crude, and the number of bids, offers, and trades getting done is at a high level right now. So the liquidity is strong. Market participants are being thoughtful about what is deliverable in the market and what logistical considerations are. We talk with people about that sort of thing all the time. Can these bids and offers be performed upon? Can the cargoes get loaded and moved out of the region as they need to be? And the market has actually been rather orderly so far. And again, participation has been strong, many companies involved, and lots of bids, offers, and trades. So liquidity has been there this month on both physical and paper.
Looking at the sort of reconfiguration of the Platts Dubai, that with Murban and Oman, the remaining two as they're delivered outside the Gulf,
Yeah.
is that did that leave the contract with too little oil? Would there be a consideration or still consideration now that temporarily should have maybe add
Sure.
alternative delivery of other oil?
Well, thank you for the question, Sean. How much crude oil do you think is deliverable against Dubai with Murban out of Fujairah and Oman?
How much do I mean,
Yeah,
would I add the barrels together?
sure.
Is it 2 million or so?
2.5 million. That's
Two and a
right.
half million.
Yeah, so I didn't mean to, I thought I'd ask you a question.
No, yeah.
You're not used to that, right? So,
Yeah,
so
exactly.
the typical deliverable volume against Platts Dubai using all five grades of crude oil is about 3.5 million barrels a day. Today, it's 2.5 million barrels a day, potential deliverable volume against Platts Dubai. So yes, it is less than it would be in a typical month, but it is still a strong volume of deliverable crude oil against the Platts Dubai benchmark. Our estimate for what a crude oil benchmark needs to have deliverable against it to be robust is at least 1 million barrels a day. This is 2x times that plus extra, right? So the liquidity profile is different, but it's still strong. Arguably, the deliverable amount of crude against Dubai is the same as it is against Brent, even today.
What do you make of efforts by some of the large Asian consuming countries to stop using Dubai pricing and sort of insisting that sellers offer them rent-related crude these days?
Sure. Well, I understand the sticker shock that buyers experience when they look at the value of Middle Eastern crude oil, whether it's the Platts Dubai number, an exchange number, let's say from another exchange that offers physical crude deliveries out there. And so I understand the mental process that takes a buyer down that road. What I've been sharing with folks is if you need to buy Middle Eastern crude oil, whatever your reference price is, you're still going to have to pay the value of that barrel. So, look, Brent futures have been considerably lower than dated Brent. Dated Brent's been lower than Platts Dubai, although, as I mentioned earlier, they're actually starting to converge back again now. If you price off a different reference price to start with, you're still going to have to pay for the value of the barrels that get delivered to you. So your differential will just be bigger as a result.
Dave, I just want to finish up our half hour together with your reaction to a survey question that we've been asking. We polled 100 energy market executives earlier today, and the results on when oil and gas flow through the Strait of Hormuz would return to pre-war normal levels. And we gave them four options. I was hoping we could pull it up on the screen so you could see it, but I'll just talk you through it and see if they could get it up on the screen. But essentially, end of April got 17%, end of May got 6%, end of June got 8%, and not before September got 69%. Um, Oil and gas flow through the Strait of Hormuz to return to pre-war normal by. I want to get your thoughts on that. Your thoughts on, I mean, obviously the politics of it all are very difficult to even for any of us to get our heads through it. But ultimately, if this continues, as it's certainly now into the second month, what greater challenges are we still ahead given this, at least this is the view from a market point, at least this morning?
Yeah. Well, Sean, you've got four possible answers here for when oil and gas flows could get to pre-war norms. You could have added a fifth option, which would be never. And there's a real scenario here where oil and gas flows through the Strait never get back to pre-war norms. Maybe it's less likely than Q4, which is the most popular answer we see on the screen here. But there's an argument that it never gets back to normal, and that we're actually now in a different world and a different paradigm. None of us knows what's going to happen between the U.S. and Iran on their negotiations. I think it's deliberately ambiguous where this conflict might go next. That's the nature of conflict, I presume, is you don't signal necessarily what you're going to do on either side of the conflict before you do it. But the uncertainty and instability has been generated by the Strait being closed is probably going to rewrite the future of these markets completely. So end of April would be wishful thinking at this point, given that it's already the end of March. By the way, the norms part of this is important because there's so much backlog, so much backed up traffic that it would take 2 to 3 months to clear, even if the Strait reopened during this podcast, Sean. So, this is the first couple of months here are about logistics. The back of the year is about reform, I suppose, reform of the market, reform of behavior, and where that ends up landing. But I would certainly be in the not before September category myself because logistics and trading norms are going to evolve based on what we've been seeing in the last 30 days.
And given this sort of underpinning this ultimately is the point you're making. I think these answers is just a shot at moment in time, but ultimately there is a sense in the market that there is structural shift here. What exactly it looks like, doesn't look like, what time will tell. What does it mean, do you think, given that this structural shift will bed in some way, shape, or form? What does it mean for the benchmarks east of Suez in particular? Still fit for purpose regardless of the shifts, or will there be a continuous sort of dynamic of tweaking and reconfiguring your thing?
Yeah, well, our job, as I see it at Platts, is to make sure that the benchmarks are fit for purpose and do represent market value. And I am confident that they have been and will do. Now, our benchmarks evolve over time to reflect how markets change. So we've brought crudes in as alternative deliveries for Dubai over the years. We brought in Al Shaheen and Murban about 10 years ago. Maybe we'll bring in more in the future. It's a question that we will come to in time to get people's feedback on that. We brought in alternative crudes for delivery on Brent, right? We brought in Midland WTI about 2 years ago now as an alternative delivery. So there will be conversations that people will want to have with us. Some people have already asked us the question about whether there could or should be other alternative delivery grades. It's a question we'll come to in time, Sean, as the markets need to have that discussion. I would say we're still in a bit of a triage situation in the market. I mean, not with the benchmarks. The markets are still finding their sea legs right now, given what's going on. But as things settle down, we're always open for that conversation.
Well, we're going to have to close this conversation, I'm afraid. It could go on forever. Dave Ernsberger, President of S&P Global Energy, thank you so much for joining us today and sharing your takeaways from CERAWeek and your overview thoughts on the global oil markets and pricing at the moment. Thank you.
Thank you, Sean.